Hello, everyone. I hope that you're sufficiently caffeinated now after the break, because the next one is going to be a serious one. Now, here on the stage, I have Jamie from Orrick. And if you don't know Orrick, Orrick is a global law firm at the forefront of tech and innovation, energy and transition, and finance sectors, with a presence in 27 countries.
Something like that, we lose track. All over the world.
Orrick was ranked top, so #1 VC law firm in 2023 in Europe for 8 years in a row by PitchBook, and it was also named the #1 most digital law firm in 2023 by the FT. And not just that, you're also honored by Fortune 8 times in a row on the list of the top 100 best employers or companies to work for.
That's true.
An amazing achievement so far. So the firm specializes in financing strategies, in investments, IP protection, talent retention, data security, and is also advocating for more innovation-friendly policies, bringing a vast experience from a client base of over 4,000 high-growth tech companies. More than 100 of them are unicorns, and they're advising over 2,000 venture financing deals totaling in $80 billion. So, Jamie, you're part of the technology companies group, and you're going to share maybe also a bit more about that, representing startups, but also their investors, including top-tier VCs from all over the world, and individual investors at every stage of the development, from inception to the exit. You have the focus on disruptive technologies, in particular fintech and artificial intelligence. And you bring vast international experience here with you. Not only that, you're also an active participant in the venture capital community, contributing to industry standard documentation, mentoring seed cap portfolio companies, and you're also hosting office hours for the Berkeley's Techstars cohorts. I'm very happy that you're here with me, but today we're going to talk about the deal flow report that you have just recently published that has analyzed over 350 deals?
Last year, yeah, 350 deals.
In your portfolio. Now, before we get to the insights, I would like to understand, why do you consider your experience here in Europe representative for getting an overview of the trends that you see in Europe when it comes to the relationship between founders and their investors? And why do you do that every year? What is the deal flow report?
Yeah, absolutely. So deal flow originates from the idea that we would love for founders and investors to do deals on a more informed basis so that they can actually focus on the deal terms that really matter instead of wasting time and legal fees on unnecessary arguments. So we've actually been thinking, Orrick does somewhere between 2 and 3 times more deals than any other law firm in the venture capital space. And we have just a wealth of data every single day by virtue of the just sheer volume of deals that we do. And so I think 8 years ago, I got really annoyed by another senior partner at another law firm demanding that their particular term was market with no grounding for that argument. So I thought, why don't we break the system and make sure that we actually have the data behind that? So that brought out Deal Flow, which is a free report that we issue every single year on market terms.
What we already know, of course, is that the venture capital investments dropped significantly after the pandemic. Based on the data and the analysis that you made on the data in the report, which are the notable trends that you see when it comes to the deal terms here in Europe?
Yeah, absolutely. So it's a big report, there's lots of data, and I have a tiny window to give you the high levels. But in a nutshell, and I'm definitely Mr. Positive, there's no doom and gloom on this. Obviously, last year was a tough year. The market did drive some slightly more investor-friendly terms, but in our experience, we did not see that through a massive decrease in valuation, as most people expected, or most people love to focus on valuation because it's the scary one. Instead, we saw an uptick in things like more strenuous consent matters, information rights, and then a slightly painful approach to warranties and disclosure that is ultimately putting more risk on founders than perhaps there should be.
How much should it be?
Yeah, exactly.
How do you measure that?
I'd say in a roundabout way, we're moving back to more of a more sustainable form of investing as opposed to being a complete swing towards like the investor-friendly side. So there's pros and cons. I think we saw deal value drop somewhere between 10 and 25% depending on each stage. And that was, in terms of actual aggregate amounts invested, that wasn't necessarily due to the market, but just more specifically due to the huge expansion of seed and founders looking at alternative means to get financing. So instead of doing direct long-form equity investments, with the later stage kind of getting a bit quieter, folks were looking towards safes and ASAs, so it meant lots of rounds at a far smaller investment amount.
So I guess also because the windows of the investments are much larger now. So
that's it.
Yeah.
That's it.
Okay. So can we speak now? Are we speaking now of an investors market? It changed the dynamic?
Yeah.
Are we there yet?
It's a really interesting one. Deals are taking longer to close, which is a big pain point for us, and that is partly because some of these extra control rights are being more heavily negotiated. The information rights are more strenuous for companies. But also, we've just done a further iteration of the standard form documents at the BVCA, which represents a completely new shift in how founders and investors engage with the warranty and the disclosure process. So, traditional old school English venture capital is, how do we sue people and where are the kind of small bits that everyone should be afraid of? We're actually trying to move to more of an American model now within the UK where disclosure should be more about information sharing, and that hasn't really sunk into the market just yet. And so that's creating a bit of a pain point. But there's still some, notwithstanding the improvement on the investor side, there is some real positives for the founders out there as well. So increasingly, we're not seeing anything as crazy as the Zuckerberg approach to voting on boards, but we are seeing protection of founders with founder consent rights and vetoes on drags and things like this.
I would be curious if you can share also a bit of a more anecdotal experience. Like, I guess in the audience we would have, the majority of you would be founders, right? Maybe you can raise your hand. Okay.
Founders.
Investors. Okay.
People who don't want to put their hand up. There we go.
Yes, they want to stay anonymous. But okay, let's move on the founder side. So what are the issues currently that founders need to be aware of or potential pitfalls in these term sheets?
The main piece of advice that I'm reminding founders on a regular basis is that we can no longer think of these deals as like a one and done, like sign the documents, forget about them, and of course we'll tear them up on the next deal. That does not work anymore. Every single thing that is going within term sheets, and particularly some of the findings that we have in deal flow, create an ecosystem, a benchmark, precedent for the next round. And so it's super important to spend time at the term sheet stage to make sure that these terms are actually agreed properly. We had an experience just last week where a company had signed a term sheet, super excited, hadn't spoken to us first, and they'd agreed to loads of stuff which we just then couldn't get rid of because it was already in there. So focus on the term sheet on a more granular basis is super important. Remembering that these things form the basis of a longer relationship and growth trajectory for companies instead of just being a one and done. And then ultimately, I think, benchmarking for additional time on fundraising. If founders are about to run out of money in a month, they really should have been thinking about raising a long time ago.
I was wondering also, are there cultural or jurisdictional differences between the countries, because you're present in so many markets, and that's a unique perspective that you can give. Like, are investors behaving and expecting different things, let's say, between those who are based in the UK and those who are based in Germany?
Yeah, 100%. And so Dealflow currently has quite a strong European presence. We're starting to also involve some US data because I love spending time between the States and the UK. But the difference between England and Germany, for example, is the level of standardization is not the same. So they are trying to gear up to the same level of approach as we do with the BVCA. They also have a very different concept in terms of how boards work in Germany compared to the UK. So we perhaps have more fights here in the UK about how governance should work and how many people should actually be in the boardroom.
Thank you, Jamie. Thank you for also analyzing this data. I was very impressed by the report. It gives me also a better feeling of what is happening in Europe, because with all the downturns, most of the deals were not public.
Yeah.
So for us in media, it was very difficult to gain an insight of, okay, what is happening? Like, who is winning now? Who is losing? Who is on the side of the market is on whose side? The founders or the investors. And I found the report very insightful.
Thank you.
If you're interested in the report,
the report's online. It's free. You can go and get hold of it. I'm sure we can distribute it as well. And there's an absolute army of Team Orrick here today. So if you have questions, come and talk to us. We're more than happy to share insights and talk about more detailed stuff. Like, the level of detail on this thing is huge, and we've turned this into a dashboard now so that our Orrick lawyers actually have up-to-date data sets on what the market is doing, so we're doing the best negotiations we can.
Cool. Thank you, Jamie.
Thank you so much, guys.
Thank you, guys.